All right. A minute past the top of the hour here. First and foremost, I want to thank everybody for joining in for today's TMC Connect web broadcast titled Market Uncertainty, the latest 2020 and 2021 opportunity outlook and strategies for moving forward. Headlined by our great friends and preferred partners at Emergent. And would advance the slide, Laird. So just as in getting things started today, I just want to go through a couple quick items. First and foremost, encourage all attendees on today's discussion to check out our TMC Connect and TMC member event calendar pages on our website to view a schedule of upcoming TMC Connect broadcasts. I have 8 sessions in total on the docket that we're hosting this week, so I encourage you to keep checking in as we'll be continually adding and updating new sessions to the event calendar for the weeks to come. And we'll keep tackling the great topics that you're feeding us from our membership to address and try to provide best practices and insight. Also encourage our members on the line to check out a pair of key Mortgage Collaborative member benefits. First off, our Ask TMC message board forum. It's a great resource for best practices and opportunity to ask questions of your fellow members about different scenarios or issues that you're facing within your operation to harness the collective brain power of the network, as well as our TMC benchmark solution, which provides our members leveraging it more than 40 key performance indicators on a monthly basis to help provide actionable insights to help run their businesses more effectively and more profitably. Kind of going through a couple ground rules for today's discussion before we jump into the dialogue here. First off, whether you've dialed in or you're connected via your computer, all lines have been muted for the call. And this is done only to avoid any background noise in your area and just to ensure that all of our attendees can clearly hear today's presentation. Now, we do want these discussions to be as interactive as possible, so please feel free to submit any questions that you have throughout today's discussion, and we'll go ahead and verbalize them towards the tail end of the call with our discussion leader. You can submit those questions either via the chat function or Q&A box, both of which are accessible at the bottom menu on your Zoom screen. And today's call will be recorded and available for playback. And you'll also receive instructions to access a copy of the recording, as well as a copy of the presentation deck in a follow-up email that you should receive tomorrow. Go ahead and advance to the next slide. So leading today's discussion, first and foremost, we have Laird Nasuli, who is the CEO at Emergent. Hi, Laird.
Hello.
And also leading today's discussion, we have Bernard Nasuli, who is the Chief Operating Officer with Emergent. Hey, Bernard.
Good afternoon, everyone.
Good afternoon to you. And, first and foremost, extremely grateful to you both for taking the time out of your busy schedules, not only running an organization, but also parenting from home, as so many of us are right now, and still finding the time today to lead and share your insights for the benefit of our members. So as we dive into today's discussion, there's plenty of factors that we're all well aware of that have created this current market uncertainty. And on the road to recovery, I think it's becoming more and more obvious that homeowners and potential homeowners are going to be affected very differently, due in part to the credit or tightening credit box, and really a multitude of factors, which I'm sure Bernard and Laird will speak to as part of that discussion. So on that note, I'm going to turn it over to Laird so we can jump right in. Laird, the floor is yours.
All right. Well, thank you, Tom. I really appreciate the opportunity to talk about this. When I look at the title, Market Uncertainty, I have to talk a little bit about first what Emergent does so that you understand why this is such a relevant topic to us. We've been in business since 2001, and our mission statement has been to help lenders navigate uncertainty. So this is right up our wheelhouse. And obviously the last 5 to 10 years, 5 years really, have been pretty stable in terms of we've seen increasing growth year over year. And lenders have been facing a lot of different challenges, a lot of profitability challenges, operations challenges. But now we really are looking at a new type of challenge. And it goes alongside with, the impact of COVID-19 and all the different types of uncertainty that that's going to cause. We're going to go into that today. I'm going to advance the slide here. And as I started putting together my outline for this, I realized that there's so much data that's involved with the opportunity outlook, and so much additional information, and really topics we could really delve into when we start talking about the strategies for moving forward. So the TMC, we've talked to TMC, and I think this is going to be the first of multiple webinars. And so what we're really going to talk about today and set the stage for this whole webinar series is we're going to talk about our current outlook. I actually have not released it to the public. You're going to be the first to be hearing our new outlook. We're going to talk a little bit about what that is and why it is. And we're also going to talk about the data and trends that we're going to be paying attention to really daily, weekly, but you'll be hearing from us, every couple of weeks as this continues to shape what our origination market estimates look like. After we go through that, I'm going to talk a little bit about the lender impact, kind of what does this mean for you? And then we're going to finish up with just a glimpse of the now what. Really that last half of this is going to be setting it up for, giving some insight into the best practices that we'll talk about in a lot more detail as we move forward through this, and as lenders have to navigate what's ahead. So that's how we're going to go through some things. And like Tom said, feel free to send some questions in the chat box. There's going to be a lot of data, and so if there's information, you don't have to necessarily wait till the end, because Bernard will be fielding those questions as they come up. So without further ado, we're going to dive into the outlook. And so as we look at today, I created an uncertainty word cloud. And what this is I basically pulled together all the different information and articles, data sets that are all about the things that are impacting and adding to the uncertainty we feel right now. And as you can see, some big words jump out. Word clouds are based on the number of times you see a certain word in a set of text. And so we're talking about a lot of uncertainty. There's unemployment uncertainty. There's uncertainty about what consumer confidence is going to do, household wealth, government policy, risk appetite. Are we flattening the curve? What's going to happen with forbearance? What's happening with real estate, GDP, social distancing? There's a lot going on. And so the purpose of today is not to give you an answer and to tell you what to be certain about, but it's really to set up a framework for how do you cope and how do you continue to move forward when this is what you're facing. So all of those different words and factors that we just looked at can really fall into 4 uncertainty categories. And this is, each one has different questions, different data points, different ramifications for you, for your family, for your industry, for your enterprises. And the first is health uncertainty. And I'm not going to spend a lot of detail on this because this isn't my wheelhouse, but we're all asked the question, have we flattened the curve enough? When will there be antibody tests? Will there be a viable treatment or a vaccine? And most importantly, will we have more outbreaks? Looking at, as a result of that health uncertainty, there's some economic uncertainty. When can we reopen states? When we're going to talk a lot today about unemployment, are they temporary? We've had unprecedented federal and state intervention. Well, we're going to look at and think about the uncertainty of how much did that really help? How much did that go from being a liquidity saver to a solvency keeper? So that's something that we're going to be watching over the next couple of weeks and months. And then, of course, how will people feel about their economic futures? That, of course, then leads itself to industry uncertainty. So all of us, take those other 2 factors, health and economic, and what does that mean for home sales? What is that, what's the impact of forbearance going to have? How will the home buying process be impacted state to state? And then, of course, the other piece of that is, will credit tighten or loosen? These are just one of probably, or 4 of, 100 different questions we could ask that we think could have an impact on the final answer to that. And finally, all 3 of those things together add to a lot of personal uncertainty. We're all thinking at the same time that we're dealing with those other 3 uncertainties, we're wondering about, will we have a job? Are our kids going to go back to school? Where are we going to work? And how long will we be caught up in this social distancing environment? Uncertainty is scary. And that's why we're going to focus on what's a framework for understanding it. First and foremost, though, I'm going to pop back to the slide for a second. When we're looking at those economic factors, the one that we're going to focus the most on today, partly because of our model, the way that our model's built, but also because it's just so important to everything else, is that employment number. This is not good. As we look at when we're going to be opening up, different states, what experts and leaders are thinking about is what's the, how do we balance lives versus livelihood? And what does that look like in the short term and the long term? Those different questions are at the heart of all the decisions being made. So, we asked, does a reopening mean people go back to work? It was interesting as I was looking at all the sources that have information on this, and I do want to emphasize that we haven't even seen the full April jobs report. So at the beginning of May, we're going to see the official unemployment estimates, and we're going to get to be able to have more visibility into what that looks like state by state. But the question is, we know that 26.5 million Americans have filed for unemployment in the 5 weeks ending April 18th. So it's even gone up since then. Now that number of initial claims is going down week over week, but what we're really looking at is not that week over week look, but cumulatively, what is this going to look like for our country? We're looking at, I've read some different estimates for April and May with employment estimates ranging from 15 to 16.4%. That's really, really unprecedented in at least the last 50 years. And again, I mentioned earlier that the state and federal aid out there is helping with liquidity, but not necessarily with solvency. And that's on both a personal and sort of a corporate level. If states or the federal aid and the PPP are giving businesses enough to stay liquid and operating for 2 months, at what point does that help not keep them open? So again, I want to emphasize just the overwhelming importance of unemployment and really how grave these numbers are. As far as our industry is concerned, and I'm not going to spend much time on this because these are probably the data sets that you're all looking at quite a bit and are pretty aware of. Although there are relatively, I say half of the information out there is indicating that we're going to have a pretty quick rebound, and that maybe will the mortgage and real estate industry will get through this with, I don't want to say minimal damage, but moderate damage. Data, in our opinion, isn't necessarily pointing in that direction. And the only couple pieces here are 2 charts I wanted to pull out. And one is that from an actual data perspective, Fannie Mae put out a really good outlook commentary with their future outlook that they submitted or they released at the beginning of April. And again, this is the beginning of April, so we're still looking at that point, Q1 just tying up, and so some of the I guess the positive indicators are still carrying over from Q1, but they're seeing that Q1 sales, I should say, dropped 34% from last year. And that's padded by February, some of that, Q2 is estimated to be 34%, but that's padded by some of the February, March activity. Fannie Mae does a home purchase sentiment index. It dropped 11 points, the largest in history. And they also indicated that they've been looking at some analyses, and Google Trends suggest that contract signings on real estate were down 35 to 40% from a year ago. Add that to the fact that we're seeing week over week that purchase applications are down year over year, and that's just applications, that's not pull through. And we have some issues obviously on the real estate industry side. So I mentioned earlier that there are particular data pieces that are particularly relevant to our model. And when you're looking at all of those different uncertainties, they really lead to 3 basic categories in our opinion. One is that there's a supply issue, right? It's questions about supply. So that's real estate supply and credit supply. Those 2 feed in and impact very greatly demand. And the demand piece is the one that Emergent has always kind of used as our anchor in our forecasting methodology. That's what we used after 9/11. That's what we used after the Great Recession. And it's been pretty effective at projecting and predicting what does our industry look like. Not just, we're not as interested in week over week, month over month, but year over year. And how can this information help chart the trajectory we're looking at? And so with that being said, a demand model, what that really means is that we're really interested in quantifying the home buyer pool. And we identify that as the number of total households that are ready, willing, and able to buy a home within a particular period. Now, I want to clarify that's ready, willing, and able. And now Bernard's going to talk a little bit more specifically about the able category and kind of show you some of those projections we have for that home buyer pool before we do our great reveal of what our estimates look like for purchase originations. Okay, Bernard?
All right. Thank you, Laird. Appreciate it. So the first number we start with is that 2020 total households. So according to the U.S. Census Bureau, there are 123.5 million households in 2020. And we first break those two down, or break the 123 million down with a 64% home ownership rate. So that means 64% own homes, 36% don't, right? So for homeowners, we have about 79 million. And for non-homeowner households, we have about 44.5 million. Just explaining some of the numbers behind the pie chart. But then we can further divide the homeowner households into two groups. I'll go back for a sec, Larry, please.
Okay.
Thanks. And so from here, we have 78% of these homeowner households have mortgages. So that's the 61.9 million, or the 50% that you see on the pie chart. And that leaves 17.2 million, or 14%, as homeowner households without a mortgage. Okay, so again, we started with 123.5 million, and now we have three buckets. Again, homeowners without mortgages, homeowners with mortgages, and then non-homeowner households. Okay, but now, especially now with this pandemic and how it's rippling through the economy, we need to make some adjustments. And some of those adjustments will impact one of those three groups more than they impact others. But the idea is not all 123.5 million are ready, willing, and able to buy a home. So really, the pool is much smaller, and we're going to whittle that down. And Laird, if you go to the next slide, we're looking at these factors. So you saw the original pie chart had three sections, and the pie chart on this page has a fourth. And the fourth represents 2020 households that are completely out of the mortgage pool, which this year represents about 67 million households, or 54% of all the households. To give you an idea, last year, I think we were about half of that. We were maybe around 22% out of the pool. So this is a huge jump. Now, what's causing this huge jump? Let's look at these groups and identify what's the cause. So unemployment jumps out right away. So Laird showed you that chart a couple of charts earlier that 26 million people had filed for unemployment through April. We're giving a conservative estimate of another 3.5, 4 million here through the rest of 2020. So that's huge. Obviously, it has huge underwriting concerns and impacts. But that's the biggest reason why some of these households will not be able to get mortgages this year. Next is when we look at defaults. Here we're assuming forbearance numbers for defaults and delinquencies. It's at 12.4 million. And we're estimating that 20% of homeowners with a mortgage are going to be affected. So that's where that number comes from. And then coming in at factor number 3 is recent home purchases. And here we're looking at, we're assuming that folks who bought a home in 19, folks who bought a home in 18, and about 2/3 of the folks that bought a home in 17 generally will not be buying a home this year. And that goes the same for recent home refinances. So we're assuming that folks that refinanced last year are in all likelihood not buying a home this year, will not be getting a mortgage. And then some of the other factors, such as credit issues. So here we're saying, around 7 million people, 7 million households are going to experience credit issues because of their income falling or their high debt to income ratio or bad credit scores. And then finally, rounding out the other factors, we have homes that were underwater last year are certainly not getting mortgages this year. Any foreclosures from last year, even from the last 3 years, will not be getting mortgages. And then finally, the loan modifications, this information comes from FHFA, so any home retention action, so repayment plans, charge-offs in lieu, any other loan modifications. So the idea is that we started, with 123 million, but we kicked out 67 million, or 54% of the total 2020 households, which leaves you with that much smaller, 46% share when you add up the three pie slices on the left. So that's obviously, we've never seen a household pool or households that are out of the pool as large as this one. So it's definitely going to be felt throughout the industry. Laird?
Thanks, Bernard. So one thing I do want to mention about that, those are obviously assumptions that we've put together, and that's been pretty accurate. When I say pretty accurate, we've forecasted through the Great Recession, and our accuracy with those numbers, it's proven to be a really, really viable way to make these estimates. And like I said, we just got our leading 2019 HMDA data, and utilizing the same model, our 18-month forecast horizon at the national level was about 98.7% accurate. So I think this is a pretty, I think this is a capable model, and I think that it's very likely going to be predicting what we're about to talk about. So on top of that, Bernard talked about the able homebuyer pool. We're also going to talk about the willing homebuyer pool, ready and willing. Typically, we estimate about 4.5% of that able homebuyer pool actually buys a home. Well, because of basically uncertainty factors, and there's a lot of information and data and articles about fear and consumer sentiment, and I think we're just going to see that dropping more and more. We are going to reduce that 4.5% to assuming that only 3.8% of the able homebuyer pool will actually buy a home. So these are huge reductions. And, I think there's a lot of discussion about, well, if this state reopens and things get back to normal, what does that mean? But I think, Mark Zandi had this quote that I think is so relevant on so many levels to what we're experiencing. It's that, nothing about reopening the economy will be easy, but restarting businesses is easy when compared to what it's like to restart demand. So even if we get to the point where there are more households that are in that pool, how long is it going to be before people are ready and willing to move forward with that? So what that leads to is assuming also assuming, I didn't mention on the other side, that we're looking at pretty flat average loan sizes, at least for the next 2 years, potentially dropping. We're going to kind of watch that a little bit more closely. But just from a unit perspective and the home buyer perspective, what we're really looking at is a monumental, a massive drop in purchase originations for 2020. 50% drop. That's not good news. Obviously, when you look at the totals here and what total originations look like, you can see for 2020, luckily refi is going to be strong, if not even stronger than we originally forecast. But that purchase number, you look at that orange drop, it's really significant. And, that 2.16 million purchase loans, again, that's assuming that 3.8% rate of the home buyer pool, that equals about $594 billion in purchase dollars. So very much a different market than the one that we've been looking at. Kind of a couple other ways to look at this. I kind of said what we were just talking about. Looking at that drop in purchase, there's that 50.4% up here in this corner. I don't know if you guys can see my cursor, but that is the drop in purchase. And if you look down at the this area here in the refi and then the total originations, you see that refi is actually from 2019 to 2020 in just pure total originations. We're still seeing a slight bump, between last year and this year due to refi. Then of course, when we go to 2020, we see with a huge drop in refi, we see an overall originations drop even from this year to next year to negative 37% drop, 38%. So that's a challenging environment, no doubt. I just pulled this in here just to look at, if you look at those two red lines, how steep the declines were with the Great Recession's drop to bottom, which was about 472 billion, and to this, really lightning fast drop we've just seen. So again, that is our outlook at a national level for 2020. We are seeing some recovery starting with 2021, but I think that the item up for business, or the thing to talk about, is that initial drop, and then what we're going to be looking at, what does the beginning of 2021 look like due to all of those other factors that we were talking about. So what's important about that, though, is not just that national number. And this is where the more data we get, the better we're going to understand what the regional impact will vary, how regional impact will vary. And this is really important when it comes to that whole, how do you move forward strategically? Because the national market is doing one thing, it doesn't mean that every lender is going to be affected or impacted the same way in their whole footprint or in individual markets. And that's going to be really important. And as we start to see more information about unemployment risk, what basically unemployment numbers for particular metro markets, and we start to really work through that, because if you think about it, there are certain metro areas that have a much higher percent of what we call high risk industry. So like Las Vegas, a lot of the tourist environments, parts of Florida, California, manufacturing places, places where a lot of the economy is driven by what we're calling those high risk industries. So we're going to look at that. We're also going to look at how these different homebuyer pool changes, and specifically changes to wealth and income, are going to impact the home value to income ratio. Now, that's a key factor in not just how many people and what products will be used to finance homes, but also that tells a lot about who the borrower is. Obviously, we're going to see some shift in the income levels of the borrowers as this plays out. And again, state responses to social distancing and reopening could impact unemployment, but overall, we're looking at relatively small numbers or really small differences from things like, is real estate is real estate considered a necessary activity? Things like that, and process-oriented state-by-state differences are going to have a much smaller impact on regional numbers than how we look at unemployment. And then the other thing that I think is often kind of the counter to, this, say, we talk and we say, okay, this is a disastrous unemployment drop. A lot of people counter and say, yeah, but there's been, also an unprecedented, intervention. Well, there again, even at a regional level, small business rescue is not created equally. This is a great map that was in a Bloomberg article that was just updated on April 20th. And you can see a wide disparity of how much of, eligible payroll has been covered by some of the government intervention. So, a lot of small businesses aren't being rescued as quickly or as thoroughly as we'd hope they would be. And so one of the things that we do at Emergent, and I think it's as time goes on, this is going to become more important again as we get more information, but also as time goes by, and we're going to be looking a lot at how these same numbers look regionally, obviously state by state, by metro market, and at the county level. And I'm looking at my time here, it's about 1:30. I'm going to skip jumping into our Market Smart tool. I was going to drill down and show you, what it looks like when you look at purchase dollar percent change at a, we talked nationally first. This is CBSA. We could look at county. We could look at census tract. And you start really seeing that these differences, these regional differences, are going to play a key role in how how recovery looks and what your strategies will be for for dealing with it. So that's, the map you see right here is showing the change in purchase dollars, from 2019 to 2020. And you can see, the blue areas are the ones where we're looking at, a purchase dollar drop of, greater than 68%. And then all the way to the red is still a negative drop, but the markets that are going to be dropping the least, I think the lowest potential drop we're seeing in purchases origination dollars is 18%. So again, a lot of pretty significant drops. The same map here is just showing that same picture, but now instead of looking at percent change, we're looking at real numbers. Again, this is going to matter not nationally, but for individual people in individual markets. You're going to want to know what those numbers look like for your market, and that information again is going to be clarified and going to be our primary focus really over the next 2, 3, 6 months. The other trend that I wanted to call attention to is the impact that this is going to have on minority and LMI households. It's no secret that this is an area of professional passion for me. So I've been following this really closely. And this COVID crisis has both, from a health perspective, but even from an economic perspective, really highlighted the inequality that has been, at the base, structural inequality that's been in existence, at a community level for years. And what they're seeing, the data is supporting that. There's a disproportionate health impact, both on the number of cases, rate of hospitalization, the death rate for non-Hispanic whites. And that same impact holds true with the economic impact. And a lot of that comes from, the pre-existing long-term income inequality and, neighborhood factors, but it also comes from the fact that a greater percent of minorities are in high-risk and low-paying industries. So, either they're high-risk industries that are closed, or they're in low-paying essential industries, and they're forced to go to work and put themselves at greater risk. So that's going to be important to keep in mind. As well as the impact on LMI. So, we've seen historically, whether it was the Great Recession or, really any time there's a major crisis, the disease impact is greater on financially distressed households. So what this graph here shows is really that the biggest, this is confirmed cases, but they're seeing more and more that the cases in quintile 4 and 5, those that are most financially distressed, are having the greatest number of cases, and that's increasing over time as more of the general public is tested. But then if you looked at the same chart for death rate, it actually goes skews even more toward a greater number of cases of death rate in quintile 5 and 4. So those are some key data points that we're going to be watching. So what does this mean for you? Well, it means that this is a challenging purchase market ahead, especially as refi slow down. We talk to a lot of our clients who are concerned right now about the impact of their pipelines. Our suggestion is to start thinking about what's next. You're really going to be battling it out for market share, both at an enterprise level, but even at the LO sales level. I think strategic and tactical resilience and efficiency are going to be more critical than ever before. And I could spend 15 minutes just talking about some of the predictions about how this will change business moving forward, that really there is no return to normal. And then of course, the fact that location of lender markets will impact your different opportunities and threats. And finally, you're gonna have to have even more targeted efforts for diverse and LMI households, whether that's from a service or an opportunity standpoint or from a risk standpoint. And finally, this also gives you a unique opportunity to innovate, to improve, to redefine and navigate. And in later webinars, we'd like to talk about and brainstorm with you, what some of those changes could look like. Obviously there's terrible disruption, a lot of suffering ahead, difficult times, but along time, these moments of structural change come unique opportunities to redefine, business strategy, to redefine, how an industry does business, and really navigate the challenges that have been there, for decades. And finally, again, this is about action. our advice for moving forward is, start building scenarios and strategies now. Don't wait for the return to normal. One thing, again, that we're going to discuss in later webinars is, how do you use data to define and refine scenarios dynamically? So not just looking at here's what's going to happen, but here's a range of scenarios that can happen. And then obviously planning and strategizing for those. Finally, quantifying demand in a granular way. You're going to have to look by market and by segment. And finally, as you look at change and going back to normalcy, each one of these different scenes, so let's think about it going from, I'll go back to this next slide. Each one of these scenarios is a future. Once you figure out maybe what potential for futures there are, then it's going to be time to start creating strategies. You're going to have to think about what kind of demands, opportunity scenario or numbers are involved in each scenario, and then how do you walk backward from that to create strategies that really help you be successful in any of those 4 scenarios. So again, I had to rush here at the end because I know we wanted to leave some time for discussion. But we're going to talk a lot more, in the following webinars about that regional impact. We're going to talk more about, the scenarios. So I mentioned, I'll click back to this slide here, that there are going to be a range of scenarios. We're actually looking at those right now. The one I presented to you was the results of one, but as time goes on, there might be some adjustments to that scenario at a national level. What we're encouraging is that lenders do the same type of scenario building at a regional level. And that's really, backing down from that and understanding that demand in your different scenarios will help you come up with what those, successful strategies are. And then not just focusing on strategies, really getting down into the tactics and, on the ground sales activities that can help you, again, going back to that same idea, redefine your competitive advantage and, innovate and, I guess, find a silver lining in these struggling times. So I'm going to stop now so we have some time left for questions. I talked really quickly. I wasn't kidding when I said there's a lot of information to cover. And really, this is just the tip of the iceberg. So thank you, but I'm going to open it up for questions now.
Thank you, Laird, Bernard, and appreciate the insightful information and the data sets that you put together here in the first place, and for taking the time at the end to kind of wrap up here and lay out for us what we have in store for some future broadcasts. So first and foremost, want to encourage our members, any questions that you have for Bernard or Laird, feel free to submit those to either the Q&A or chat box windows, and we'll go ahead and verbalize those on your behalf. And then also stay tuned for some upcoming times in the schedule for our continuing parts of this webinar series. As Laird alluded to, there's so much to uncover here, not only looking at the data, but then also trying to provide resources from a strategic standpoint to the membership of the collaborative on tactical approaches to how you leverage this data and how you pivot to the changing metrics and dynamics that we're seeing in the marketplace. So plenty more to come. We'll wait for some questions to come in here. One that I had offhand, Bernard, Laird, in your opinion, what are the biggest factors that will impact your model forecasting over the next 30, 60 days, or even beyond in 2020? Is it simply where things are trending as far as unemployment rates go and, who's directly impacted, or are there other key drivers in that data?
Well, I think fundamentally, we're going to be looking at that home buyer pool, and anything that impacts that is going to be what we're tracking. The biggest impact when you look at those numbers is clearly unemployment. And unemployment is really going to depend a lot on this whole flattening of the curve, this reopening of states, lives versus livelihood questions. In a perfect world, states would reopen, the virus would go away, and this would be really a hiccup. That's not what the information and the data is pointing to as being the likely scenario. What we're really looking at as states reopen are going to be some, intermittent surges of the intermittent outbreaks, as they're calling them, regional outbreaks. And what that's going to mean is that there's a start and a stop. And if you think about that, everyone was talking earlier about a V or a U recovery curve. I don't see a path for a V anymore. But we did have someone mention that it could be a W, as we go through that type of, start and stop, to different regional economies. Problem with a W when you're looking at something like our industry is that a W really equals a U. And that's because there's no short-term decision-making and short-term economic health factors involved with the home buying process. So I think unemployment is going to be the biggest driver. I think that home buyer pool could also potentially be impacted by, what we do with credit. So those two other supply questions, what is happening with real estate, and then what is happening with credit. So what rates do, and how do we change, that our definition of who is able to buy a home. That could have an impact on that home buyer pool.
I'll piggyback on that, and I think I've heard some other economists mention potentially a Nike or a swoosh type of recovery, so that we're going down and then it's a slow climb up that'll probably take 12, 16, 24 months. And that's certainly a reasonable assumption and within the realm of possibilities. And the other about tightening credit, I think what will be working against tightening credit is social appeal to folks who are clearly needing some help. And so any bank that tightens credit or is extremely strict with its credit decisions might pay in the realm of public opinion.
That's a great point, Bernard, too, especially as you relate to the credit box for first-time home buyers as well. Nobody wants to be seen as the impetus to preventing what would traditionally be qualified borrowers from entering the marketplace.
Right.
And the other thing to add on, Tom, is just, I see this as being, when they say that there's not going to be a return to normal, I see that this as being one of those events. Not necessarily normal in terms of, we'll return probably, by 2024 to the same opportunity path we were following. But the thing is, what is it going to look like? What's business going to look like? I've heard discussions about, again, what are credit models going to look like? What is LO comp going to look like? We were on a webinar with NAMBA last Friday, and that was a big part of the discussion, is what's going to happen with comp. I think we're going to see some industry changing and economy world changing shifts that are going to change how we do things from here on out.
Absolutely. That's a great point. Last call for our attendees. Any questions that you have for Bernard and Laird, please feel free to submit those through the Q&A box or the chat function. Another one I've got here, in your data modeling, are you seeing any sort of urban-rural divide in forecasting effects on the housing market or on the purchase opportunity report? Or to this point, is it too early to tell?
It's a great question, and it's what we're spending a lot of our time on. I was actually digging into this data at that local level, and I do think we're going to see a difference. Not necessarily the kind of difference that says one sees no impact and one has a terrible impact, but I think we are going to see a difference when you look at density of population, just because there's just inherently more risk the more people are in a particular area. And I think we're gonna get some more information about how that plays out when some of the more rural states, maybe move away from the social distancing model earlier, and to see how that goes. Like we're in Iowa, I think how this is playing out in Iowa looks different than it is in definitely in Detroit or Michigan and the New York and Massachusetts and Connecticut. I think it's going to have there's going to be some pretty significant differences. But again, time's going to tell. In a way, we are at the, we're at the, what's the word I want? Not disposal, but the mercy of what the virus does. Whatever happens with that and what the virus outbreak looks like, I think is going to have a big impact on the choices we make and what recovery looks like, again, over time, but regional differences and with market segment differences.
That's a great point. Now, I'll be interested to see, too, as we continue on in this series and maybe more data presents itself, how that urban-rural divide takes effect, or to your point, maybe it's more so based on kind of the regional differences as far as the social distancing practices in place, or how quickly certain states compared to others start to reopen their economy. Be interesting to see, too, if there's certain metros that buck what might be more of a traditional national urban-rural divide that we'd be inclined to think we'd see.
And I think from a negative perspective, I mean, I hate to do that, to draw attention to this, but we have to. I'm very, very concerned about these underserved markets. I was working in Memphis right before social distancing started on an affordable housing initiative. And the first thought I went after hearing about how disenfranchised these homeowners and potential homeowners were from the Great Recession. The first thing I thought was, I mean, this could be, a fatal blow to sort of our plans if we don't come in with new strategies and new interventions to some of those communities. I think it's going to be really, really challenging in particular neighborhoods.
Great point. It'd be interesting to see as things continue to remain fluid and really just about any market right now. So on that note, time for today's discussion, but like we alluded to, definitely be on the lookout for part 2 of a continuing series of discussions that we've got lined up with our friends at Emergent. Again, I want to thank Bernard Laird. Thank you so much for sharing your invaluable insights, some of the data that you're collecting, and sharing the information and some of the thought processes, potential strategy out with our members to be keeping an eye out for, as well as all of our members for joining today. Not lost on us as we approach month end and how busy everybody truly is right now, for taking some time out to spend it with us today.
Hey, and Tom, I just want to say one other thing, and that's that, we talk about this and we want to share this in webinars, but this is what we do. So if you have interest in knowing before our next webinar about your markets, we have that information now and we're looking at it. So feel free to reach out. We have a lot of different ways we share the data. And a lot of tools and approaches for how you can use it wisely. So, you don't have to wait for the webinars to hear more.
That's a great point. Emergent's always been very forthright with our members and looking to drill down into certain metros and being able to share insights for, potential opportunities for growth that they're looking to take on. So thank you for making that mention. I do appreciate that.
Thank you so much, Tom. And thanks to all of you, and be safe. Be healthy.
Well, you guys do the same. That's right. Everybody stay safe, stay healthy, and stay sane. And enjoy the rest of your day.
Thank you.
Bye-bye.
Bye-bye.